So inflation worries in the rearview mirror, or not so fast? Okay.
Oh, come on.
Boosting expectations, but not mine. You have to look under the hood here. There's a couple things to remember going into this. That CPI, we didn't have one in October.
Right.
So the government put in all zeros for the month, and that's artificially biasing the numbers down and will through April. So you've got some problems already with the CPI construction. We did see tariff inflation in this report. A lot of people didn't notice it, but you have to look at the individual sectors. And you saw things like furniture, appliances up 1.3%, video and audio up 2.2%, and computers and software up 3.1%. So we're getting that pass through, and the question is going to be, does that continue, or do you get the Chris Waller argument that it's a one-time thing? But there's probably other things that are going to see prices go up. And then the supercore, take out housing, which was low but artificially depressed by the fact that there wasn't anything in October. The supercore was up almost 0.6, so it was a significantly stronger supercore inflation print. The whole thing was kind of held down by gasoline falling significantly. So you take those things out and you say it's not quite as good as it looks, and it's not really going to give the Fed a whole lot of comfort.
What about the political angle of this and the politically sensitive stuff? Grocery prices, electricity prices, what we're paying utilities. I was getting emails all month long about brace yourself for a bigger bill because of the cold weather.
Well, that may still be coming, especially for natural gas. But in this collection of data was done primarily through the first part of January, and then they finish it up in the latter part of January, and we didn't have the storms until the latter part of January. So we may get some of that bleed through, especially if you're getting billed on a later cycle. You know, if your January spending for utilities comes in February, that's when it'll pick it up. But the most important thing here, to go back to what you said, let me just say, if I were the White House, I'd be happy about this because grocery prices were pretty flat. They came down significantly from what they had done in December. And also gasoline prices have come down a lot. Nothing to do with the president, but presidents get the credit for things that happen on their watch. So they could sell that, but it's not going to sell to the Fed.
That's where I want to go. So this was a big week. We got finally a monthly jobs report on Wednesday, and then we got the inflation print, or an inflation print, and an important one today, Mike. So dual mandate in terms of the Fed, where are they? Are there still risks to both?
Yes.
Okay.
The jobs numbers were stronger than anticipated, and so that gives you some hope that maybe things have flattened out at this point. We're not seeing tremendous hiring, but we're also seeing, the labor market is smaller. Unemployment went down, so at this point the Fed doesn't have an excuse to cut rates because of the employment mandate. And the thing about the inflation mandate is they use the PCE. They don't use the CPI. Next Friday, we get PCE for the month of December. This was January CPI, but PCE is delayed because
Sorry, CPI, we actually do love you on this inflation, on this Valentine's Day, but it's not the Fed's preferred.
It's not the same. Yeah. That's your side hustle there, the CPI.
Exactly.
The PCE is, according to economists surveyed by Bloomberg, the consensus is it's going to rise for the month of December, and it's going to rise to 3% or more. Okay. And the Fed is not going to be cutting rates with inflation at 3% and going up. So it doesn't give me any comfort that the CPI went down, and it would not make me invest in Fed fund futures predicting a rate cut.